Good morning, this is Ken Long from Tortoise Capital Management with a review of the weekly trading plan for October 5th, 2012. We have a market that's still in bullish quiet. On an annual basis, using weekly RSI 14, we're neutral, at the high end of neutral. The score is 67 out of 100. We're at 86 out of 100 on the 10-day NDX, so we are short-term overbought. Percent stretch relative to the 200-day moving average is 7.84%. That's white bullish, an improvement over last week. The slope of the 50 is green bullish, also an improvement at 0.76%. ADX improved to 26.4 and has returned to strong upward trending. ATR percentage is 0.86%, which is right on the boundary of quiet and normal. It's been so quiet in the last month or so, and we're dropping off volatile percentages from 6 months ago, so the market is slowly adapting to the new quiet as becoming the new normal. The blended monthly rebalancing, current holdings, you can see in the 26 ETF is energy, gold, and Asia less Japan. In the 13 ETF portfolio, it's Australia, Asia less Japan, and technology, with the next reevaluation due on or about 1 November. The theoretical exposure in ETF 2 is still at 100%. The model portfolio is also at 100%. You can see in the 13 ETF portfolio that only long-term treasuries are on a cash position based on their price being less than the 4-month moving average. Everything else is green and a buy. And you see currently the top 3, Asia less Japan, Australia, and the spiders. In the 26 ETF portfolio, also long-term treasuries are the only cash position, and the top 3 are gold, European 350, and energy. In the market health check, the vertical blue lines represent 10, 20, and 30-day look-back periods. The horizontal purple line at 147 and some change is the swing high achieved earlier in September. And the horizontal red lines represent important support levels from previous upward moves. The blue thick river is the 30-period Bollinger Band plus or minus 1 standard deviation. The center black line is a 30-period regression line pointing upward, with the outer line forming the channel created by the maximum excursion from the regression line during the look-back period that was formed at the swing high in early and mid-September. Solid green line is a 10-period moving average, which we would treat as fair value. We've got price now tested the swing high at 147 on Friday and pulled back to the main center line of the regression line. This horizontal blue channel is an Andrews pitchfork, which extends the regression line going forward and would represent a normal channel for price unless something fundamental changes that would shift the way this regression line and channel are forming. The thin red line is a 50-period moving average. That's just below the regression channel, just at the edge of the river, and so we would see very strong support in here at about 142.5. The confluence of all those, which is also a key price level from when the ECB made its announcement of unlimited credit back here in early September, creating that first upward white spiky candle you see. The thick red line in the shaded region are the 200-period moving average, and that would be the bearish territory. If we were to cross that line, that's a longer-term support level. So we have about a 5% cushion between price and the sideways market down in this region. The 5 and 10% pullback rectangles there just represent 0 to 5 would represent noise level on corrections inside here. So it's a strong support at 139 as well. That'd be a 5% pullback. It would be the lower boundary of this previous sideways channel that I've highlighted in yellow here. So both of those act as a very strong underlying support. 10% pullback would be the extreme of a correction in a bull market, and then that would take us below the 200 period moving average, but you can see the size of the price shock that that would represent. Williams percent R10 is currently overbought, and so there was a nice channeling move from oversold to overbought on this last leg up of the last 5 or 7 days. That's sort of the justification for the channeling. You can see the previous occurrence occurred here at the bottom of the yellow, and then made this move to 147, and even before that from 134 up to about 139. So when the market's in those kinds of conditions, in this bullish strong up, we would be looking at opportunities to buy on dips until failure would tell us that's over. The percent price oscillator, the jaws are closing and are opening to the upside, which suggests that there's room to run if it were to get through 147 here. And if Romney keeps doing well in the polls, you would expect that to go up a little further. So that's the market health check. Bullish quiet, upward trending. All signs point to positive, with the exception of this short-term overbought, so there's no hurry to get in. I would say a close above 147, though, that held, would be an interesting price moment. ETF2 regional summary, everything's on a buy because the all 10 are above their 4-month moving average. Spiders, U.S. is better than the globals, and inside the U.S. it's tech, large caps, small caps, mid caps. The two weakest are Latin America and Japan, which are really suffering compared to all the other opportunities out there, as you can see. I would just like to highlight the 72 under relative strength for Europe, an extraordinary run that we're going to see here in a minute on the world market model, or less than a minute. I see China lagging, India doing very well, Mexico doing very well, and this broad strength in European markets is going to push the EFA and the whole Euro region above the U.S. here. You can see now only the U.S. large caps and small cap value are above average. The rest of the U.S. has dropped back below the average, while Europe has taken the lead right now. Strength in finance and healthcare, although the rest of the business sectors are continuing to lag a little bit, with industrials and materials not participating. Gold and silver still on a good run. Treasuries have pulled back, and the bonds and real estate are suffering too. So this looks more like a rotation to Europe in the course of a normal offloading risk, I think, because of the November election is how I would interpret that. Top ETF 30. You can see it's made the usual suspects: home construction, mortgage REITs, telecom, and that would include utilities. Grains and agriculture, emerging markets, sovereign debt, biotech, silver, global real estate. So this is still a form of a risk-off trade, or a conservative risk-on trade, if you will. Looking at the Dow 30, the winners continue to win. Home Depot, which blasted through its price level of 60. That was a good intraday and then a swing trade for us at the live trading workshop, and that's been the clear winner. Look at that on any time frame you want over the last 5 years, and you'll want to own Home Depot. Lagging at the bottom down here, Hewlett Packard, Intel, Caterpillar, Boeing, and Microsoft. So this is very much an Apple economy, that the strength in the techs. ETF liquidity, you can see the big winners in terms of daily dollar volume and intraday percentage, ATR percentages. That just gives you a hint of which ones are very tradable. Looking at regression line crossover with respect to the river, strength in the U.S. on the basis of the past week of grinding upwards. Treasuries hit the far side of the river like you would expect, and we were able to cash a good swing trade here on the normal oscillation of the 10 around 30. Gold preparing to take another leg up here, and small caps are lagging just a little bit behind spiders. As you can see, their 30 has rolled over and come back to the edge of the river, whereas the large caps 30 is still pointing up, and the 10 is getting ready to leave the river. So slightly more strength in the large caps than the small caps inside the U.S. We're going to leap ahead now to the daily report. Okay, on the gap stat, we have basically a neutral probability now on the gap down, whether it reverses or drops, but the follow-through on the gap down and then reversal higher has been returning twice as much as the gap down and failure. So that's the morning hook scenario, still the most lucrative one in terms of average follow-through. So that's a good way to play it. And you see the gap up has started to normalize also. There's no real advantage one way or the other. It's about a 4-to-3 ratio on the gap ups. So the gap down is still, and then playing for morning hook is still the best payoff available. Standard overnight standard deviation in SPY is down to 0.53. You can see that we're overbought now on a short-term basis. No signals in overreaction or channeling. In volatility, you can see how it's the ATR percentage, which used to be very quiet, has now come right up to the lower boundary of normal. And what's happening is we're at this lower levels of volatility, we're adding volatility here, low volatility there, and then we're losing this high volatility from 6 months ago. Of 100 days ago. And so that's making this, what used to feel very quiet, to become the new normal. So we're going to be cautious about volatility spikes as we approach November. In the pattern trades, VIX on a washout, 551Ws in Latin America Energy, DuPont. A couple good auto framing trades. This MDLZ is a new symbol for craft. Then we have old reliable Cliffs Natural Resources and Treasuries. The 10-day max pain candidates, I still like this as a source of ideas for one-day pops up. Hewlett Packard, Caterpillar, Microsoft, DuPont, and Verizon. Those are really good names. Very, very tradable. Kraft has really, its reward to risk ratio as a max pain range compression is kind of extraordinary. I think there's opportunities there tactically. Only a couple dojis in Intel and American Express. Only a couple patterns in the ETF 30. You get treasuries on channeling and overreaction. Treasuries test out pretty well, 3.8 to 1. So it's now time to start stocking that for a potential move. Looking at the market mosaic, see the regression line. The price rejected the upper boundaries. That's a combination both of the center line of the regression and then also that high here at 147. This is the third test of it. You can see that the regression line slope and its 10-period moving average have come right back together. This is a perfect moment of pause and hesitation where you have an equally likely probability of a 5% move in either direction. That would fit well within normal here, looking at price with respect to the 200 and then the longer-term regression line channel. So there's a perfect moment for a swing trader with no directional bias. You can see the 90 has formed a cup, the top half of an inverted cup here. The 30 is at a 1 standard deviation high in terms of slope. The 10 has come back to the edge of that one, so this is a natural place for a 5% pullback, which would not jeopardize the longer-term trend at all, but it would just be part of the normal oscillation and a test of this at 147. So if we saw a breakthrough above 147, however, another 5% is available to the upside. That would get us past 150 for sure in the S&P, and then that would be some evidence of a continued grinding upward bull. And with the pullback in the U.S. relative to the Europe, that wouldn't be an unlikely scenario at all. So no directional bias, 5% move available in the next week to 10 days, and you should be poised for either one of those moves. Just a quick look at the frog numbers for reference and the fail stat for reference. You can pause that if you need to. And the signal to noise ratio. I like Coke and McDonald's up here. Very strong directional intraday moves. Very positive. And the holding X-day periods, just for your reference. Defensive plays in the Dow. The Dow is up, so the conservative large caps are working while the risk-on trades in the U.S. have been relatively failing here. and that's happened while the regionals have moved up, but they're starting to show some little bit of overheating. So wouldn't surprise me here to see the Dow start to lag, and then see the risk-on cluster of small caps, mid caps, and technology roll up. Commodities have had a nice run here, but rolled over on Friday. So the relative weakness in the U.S. starts looking good on a cycling basis. Right in the middle of the wheelhouse on channeling of the safe zone channel for S&P. You can see the gap statistics for your overnight holding reference, as well as intraday range staff percentages, if you're using percentages. And that's everything I want to cover on the weekly report. So thanks for your attention. Good hunting. Keep your risk measured and your reward calibrated.